Hello my dear CA final students. So this is an RTP discussion for May 23 exam. So they have not given any new set of questions. So whatever we have already known, so that questions only they have given except for the first question. So that's like case scenario MCQs, but others are like routine questions only, barring one or two questions. So we can see this MCQ part first. So Mr. X is engaged in business of supplying FMCG, like that one case scenario question has been provided, and for all case scenario questions your approach should be, first you need to see the MCQs, because the question will go into 1 page, 1.5 page and all. You may be lost as to what is the requirement that we need to do. So that's the reason why. So first we need to refer to the MCQ part. So you can see the MCQ part here. In respect of the goods supplied by X to its agent A in Rajasthan, the value of supply will be. So they have given some transaction here, that is there is one person Mr. A and X who is making supply to his agent A in Rajasthan. What is the value of supply? That is one question. Then second, GST payable on the service of incorporation of a company provided by Rudra Consultancy. So there is one incorporation service which they are receiving. So Rudra Consultancy is receiving, that X is receiving from Rudra Consultancy. So what is the GST payable with respect to that? Then next we have, which of the following statements is true in respect of import of digital data warehousing service and online gaming services? So we need to bother about the taxability about these two transactions. Which of the following statement is true in respect of sponsorship fee paid by Rajasthan branch of X? So related to sponsorship fee there is one MCQ, and computation of net GST payable by X in Madhya Pradesh. Okay. So these are the various questions that we have MCQ. So let's start reading this case scenario MCQ. Mr. X is engaged in the business of supplying FMCG goods to the consumers on retail as well as wholesale basis. X has its head office located in Delhi and branches in Rajasthan and Madhya Pradesh. So they are located in Delhi, Rajasthan and Madhya Pradesh. It has registered under GST in all the three states. During the month of January, following transactions were undertaken. So each and every transaction carefully we need to analyze. So first we need to check whether it is supply or not a supply. Second, we need to check whether it will be taxable or exempted. And third, we need to check who is liable to pay GST with respect to that. Okay. So these are the three aspects that we need to check in each and every transaction. So first one, X supplied goods to its agent A from its factory located in Rajasthan. A sold the same to unrelated wholesalers in the state of Rajasthan by issuing an invoice in his own name. Whose own name? A's own name. Means A is acting as an agent on behalf of principal. When an agent will be acting on behalf of principal, when the invoice is raised by the agent in his own name, then the agent is acting on behalf of the principal. So in this case, A is acting on behalf of principal. Now, when an agent is acting on behalf of principal making supply to the agent will become supply under 7(1)(c), even though without consideration. So in this case, it is supply under section 7(1)(c). It is supply under section 7(1)(c). And it will be chargeable to GST, and what will be taken as the value? So the value will be determined as per rule 29. In case of principal agent transactions, the value will be determined in terms of rule 29. And what will be taken as per rule 29? Open market value or 90% of the resale price. What is the open market value? If you see, the goods of like kind and quality were sold by A to an unrelated customer for 1 lakh. So resale price is 1 lakh. 1 lakh into 90%. 1 lakh into 90% is what? 90,000. A also purchased goods of like kind and quality from other independent supplier for rupees 80,000 on the same day. So 80,000 is what? Open market value. So in this case, what will be taken as a value? Either 80,000 or 90,000 at the option of the supplier. At the option of supplier. So generally supplier will go for which option? Lower value option at the option of supplier. So therefore 80,000 will be taken as the value in this case. Then second transaction, X appointed a consultancy firm, and also first transaction if you see, is it intrastate supply or interstate supply? X supplied goods to an agent from its factory located in Rajasthan. Okay. A sold them to unrelated wholesalers. So where A is located, so A, X supplied goods to its agent A from its factory located in Rajasthan. A sold the same to wholesalers in the state of Rajasthan, which means X is located in Rajasthan and A is also located in Rajasthan. Ending point is Rajasthan only. Therefore, it will be coming under intra-state supply and chargeable to CGST and SGST. Then X appointed a consultancy firm, Rudra Consultancy, registered in Rajasthan, to incorporate a new company and to undertake all the legal formalities for incorporation of the said company for an agreed consideration of 35,000 rupees. Rudra Consultancy paid the legal fee of 15,000 rupees to the relevant government department. So that 15,000 will come under pure agent expenditure, provided the conditions are satisfied. Now what has happened, if you see, the GST invoice was issued by Rudra Consultancy on X branch in Rajasthan for an amount of 35,000 without any breakup of its own service. So which means what they should have done is that they should have shown service charges 20,000 and legal fee paid to the government on behalf of the recipient, so 15,000. Like that, if they have shown, then the 20,000 rupees only will be taken as the value of supply and 15,000 rupees will not be included in the value of supply, because that will come under expenditure incurred as a pure agent. But here what has happened, they did not show the breakup. So which means that entire 35,000 will be taken as the value in this case. So what will be taken as the value of supply in this case, and it is supply or not? Yes, of course it is supply under 7(1)(a) and we don't have any exemption with respect to that. So therefore the value will be taken as 35,000, and this is inward supply or outward supply? Inward supply. The first one is outward supply. The first one is outward supply, whereas the second one is inward supply. This is an inward supply. And what is the service? As consultancy service, which means the general provisions will be applicable for place of supply. So location of recipient will be taken as a place of supply. Here where X is located, so location of recipient Rajasthan for their Rajasthan branch, and where Rudra Consultancy is located Rajasthan. So this is an intra-state inward supply chargeable to GST, and on this 35,000, so we have to pay GST. Can that be taken as credit? Yes. So on this 35,000, how much will be taken as the GST rate? If you see here, so the rates of GST, intrastate supply 9% CGST, 9% SGST and 18% IGST. So what will be the GST? 35,000 into 18%, that will be 6,300. So 6,300 again break up. So 3,150 and 3,150 will be taken as the CGST and SGST in this case. So that is with respect to this intrastate inward supply, and that 6,300 can be taken as credit. Then X imported certain digital data warehousing services from Maison Incorporation located in USA. So it's an import of service. The amount charged by Maison Incorporation was 5 lakh rupees. So import of service for a consideration. The service were for personal consumption of X and were not used in the course or furtherance of business of X. Import of services for a consideration, whether or not in the course or furtherance of business, will become supply under section 7(1)(b). So in this case, it will be supply under section 7(1)(b), import of services for a consideration, even though not in the course or furtherance of business. So it is supply under 7(1)(b) na, and then is it chargeable to GST? So import of services, it is what services? It is OIDR services. Why? Digital data warehousing services. So whenever cloud storage or cloud computing is mediated through internet and it is automated, so it's known as OIDR services, online information database access and retrieval service. And OIDR service will always be taxable. Who will pay GST? If the recipient is non-taxable online recipient, then the recipient will pay GST and the supplier will pay GST under FCM. If the recipient is other than non-taxable online recipient, then the recipient will pay GST under RCM. In this case, if you see, recipient is other than non-taxable online recipient. Who is a non-taxable online recipient? Any unregistered person who is importing services for other than business or commerce. But in this case, the GST invoice is raised, means the recipient is a registered person, because if you see, the transaction was billed to X on the GST registration number of Rajasthan. So therefore, it will be taxable under RCM. Taxable under RCM. That is with respect to this transaction. Then number 4, X imported certain online gaming from Balibaba Incorporation located in China. The service were provided to X on free of cost basis. The open market value of such services was 1 lakh. And these services were also for personal consumption of X and were received on the device whose internal protocol address was registered in India. The transaction was billed to X on the GST registration number of Rajasthan. First of all, before talking about whether it will be taxable, etc. and all, is it first of all a supply? Because is it import of service for consideration or without consideration? Without consideration. Import of service without consideration will come in 71C if it is from a related person or other establishment located outside India in the course or furtherance of business. First of all, it is not from a related person or other establishment. Even if it is from related person or other establishment, it is not in the course or furtherance of business. Consequently, this transaction is not a supply. When this transaction is not a supply, liability to pay GST shall not arise. Number 5, Madhya Pradesh branch of X purchased goods worth rupees 15 lakhs liable to GST at 5% from Madhya Pradesh dealer and procured certain input services worth rupees 5 lakhs liable to GST at 28% in Madhya Pradesh. So, purchases is from Madhya Pradesh within the state, sales also within the state, and purchase of goods GST rate 5%, sales of goods also GST rate 5%. So, it is not an inverted rate structure. So, what is called as a inverted rate structure? GST rate on outward supply is less than the GST rate on inward supply, then it will be called as inverted tax structure. Should we take services into the criteria? No. We will get refund on account of inverted tax structure only with respect to inputs, not with respect to input services. So, we should not check input services. We should see only inputs used in the finished product or outward supply. Outward supply chargeable to tax at 5% and inward supply chargeable to tax at 5%, it is not a inverted. What if it is inverted? Even then they will not get refund. You know why? Because there is one provision which says that if inward supply, outward supply is the same product, but there could be a change in rate because of the notification, we will not get the refund on account of inverted tax structure. So therefore, in this case, first of all, it is not inverted. Even if it is inverted, we will not get the refund. And normally GST will be payable. So purchased goods worth rupees 15 lakhs, 5% and services also received 5 lakhs, 28% and outward supply 18%. So literally if you see, so their gross liability, because there is one MCQ related to this, 5th MCQ, compute the net GST liability of X in Madhya Pradesh. So for Madhya Pradesh, there is only one transaction, because if you see, first transaction is belonging to Rajasthan, second transaction also belonging to Rajasthan, third transaction also belonging to Rajasthan, fourth transaction also belonging to Rajasthan, but it is not a supply. Fifth transaction only Madhya Pradesh, again sixth transaction is Rajasthan. So Madhya Pradesh only one transaction. So what is the gross liability? 18 lakhs into 5%. 18 lakhs into 5%, gross liability 90,000, and ITC if you see 15 lakhs into 5%, we have 75,000 plus 5 lakhs into 28%, that will be 1,40,000. So we have more ITC. So therefore the net liability will be 0. We don't have any net liability, and even we will not get refund of unutilized ITC in this case. Then sixth transaction, Rajasthan branch paid the sponsorship fee of 5 lakh rupees to Ganga Solutions registered in Rajasthan for an entertainment event organized by Ganga Solutions in Haryana. So in case of sponsorship, what will be taken as the liability? So generally sponsorship will be taxable. If the recipient is body corporate or firm, it will come under RCM, but the recipient is X. Rajasthan branch paid the sponsorship fee to Ganga Solutions. So the recipient is X. So X is an individual other than body corporate or firm. So therefore it will be taxable under FCM. And is it inward supply or outward supply? So for X, it will be inward supply, because X is making the payment. So therefore it is an inward supply. Okay. That is with respect to this transaction. The opening balance of input tax credit of X in the states of Delhi, Rajasthan and Madhya Pradesh is nil. Further, there is no other inward and outward supply transaction of X in the month of January apart from the above mentioned transaction. So now, first question, in respect of goods supplied by X to its agent A in Rajasthan, what will be taken as the value of supply? Already we discussed 80,000 or 90,000 at the option of the supplier. If you have directly 80,000, you will select 80,000 only as the answer. But the answer given here is 80,000 or at the option of X 90,000. Suppose if one of the MCQ option has 80,000, we need to select 80,000 as the answer. Then GST payable on the service of incorporation of the company provided by Rudra Consultancy to X. So this is inward supply. So inward supply, what is the GST? 6,300 and the liability 6,300. Full input tax credit of the same is available to X. Yes, full input tax credit is available. 3,600 wrong answer. 6,300 and 3,600 is available. That is also wrong answer. 6,300 and no ITC. That is also wrong answer. Option A is only the correct answer. So 6,300 will be the GST paid on inward supply related to that incorporation and ITC can be availed. Third, which of the following statement is true in respect of import of digital data warehousing services and online gaming services? Online gaming services. So here if you see IGST of 1,08,000. See, first of all, only they are asking about two transactions. Digital data warehousing and online gaming. Online gaming not a supply. So we have only digital data warehousing 5 lakhs. On that 5 lakhs, GST rate is 18%. So 5 lakhs into 18%, 90,000. So 90,000 is the GST payable. So 1,08,000 is wrong answer. And even B is also wrong answer. 1,08,000 will not be there. 90,000 is only the correct option. The IGST of 90,000 is payable by X under RCM and no input tax credit of the same is available. Why input tax credit is not available? Because this digital data warehousing is not in the course or furtherance of business, but for the personal purpose of the person. So that's why IT is not available. So because inward supply should be used or intended to be used in the course or furtherance of business na, and no GST payable since import of service by individual for personal use is specifically exempt. No, that is other than OIDR service. Other than OIDR services imported by non-taxable recipient is exempted, but that is not applicable here. Then which of the following statement is true in respect of sponsorship fee paid by Rajasthan branch of X to Ganga Solutions? So sponsorship fee, who is liable to pay GST? So it is, Ganga Solutions which is liable to pay GST. So FCM, taxable under FCM, sponsorship services, and Ganga Solutions will pay, and it is intrastate. Why it is intrastate? In case of sponsorship services, B2B, we need to take location of recipient. What is the location of recipient? Rajasthan only. Ganga Solutions registered in Rajasthan. So supplier is Rajasthan and recipient is X Rajasthan. So both are in same state. That's why it will be intrastate supply. So Ganga Solutions is liable to pay GST of CGST, SGST of 45,000 each. How? See the value, 5 lakhs. 5 lakhs into 9%, that is 45,000. Compute the net GST liability of X. Already we computed, it is nil. So net GST payable is nil and no refund is available. So these are the answers for the 5 questions. Case scenario MCQs. Then question number 6. Dhumketu registered under GST in Virar, Maharashtra is appointed as a Del Creditor agent by Big Bang Limited. He sells shoes to his customers locally within the same state. Big Bang Limited is also registered under GST in Maharashtra. So they are the Dhumketu is appointed as Del Creditor agent by Big Bang Limited. So Big Bang Limited is the supplier and Dhumketu is the recipient, that is agent. He sells shoes to his customers locally within the same state. Big Bang Limited is also registered under GST in Maharashtra. Now, so Big Bang is the principal and they are making supply of goods to their agent Dhumketu, and Dhumketu is making supply to their buyers. Now, during the current financial year, Big Bang Limited supplied taxable goods. So, do Dhumketu, and Dhumketu sold it to buyers. Now, see who raised the invoice. So, Dhumketu has further sold these goods for 10.10 crore by raising invoices using his own GSTIN, which means, so invoice is raised by Dhumketu to the buyer, which means agent is acting on behalf of principal. When agent is acting on behalf of principal, then in that case, the supply made by principal to the agent will become supply under 7(1)(c), and the supply made by agent to the buyer will become supply under 7(1)(a). What is the value at which goods are sold by Dhumaketu to buyer? So 10.10 crores, 10.10 crore. Now, whenever the supplies are made through an agent, so in case of this, how the value will be determined? Value as per rule 29. Value under rule 29. As per rule 29, what will be taken? Open market value or 90% of resale price. If you see here, open market value of the goods sold by Big Bang to Dhumaketu is 9.82 crores. So 9.82 or 90% of resale price. What is the 90% of resale price? So that is 9.09. 9.09, whichever is lower will be taken as a value. Therefore, 9.09 crores will be taken as a value in the hands of Big Bang. Now, Dhumaketu received a commission of 65 lakhs. So that will also be chargeable to GST in their hands. So 0.65 crores from Big Bang Limited during the year and has guaranteed the payment of the value of such goods from the customers to Big Bang. Dhumaketu has also provided financial assistance in the form of larger credit period to his customers on which he has earned an interest of 25 lakhs. Interest earned by Del Creditor agent has two treatments. If Del Creditor agent is acting on behalf of principal, which means he is raising invoice and the interest collected is on account of delay in receipt of consideration, and that interest will be taxable. Whereas, if the Del Creditor agent is not acting on behalf of the principal, principal directly raises the invoices, then the interest collected by Del Creditor agent is mere interest on account of loans, advances, deposits, which is exempted. So in this case, the agent is acting on behalf of principal because he raises the invoice. So the interest collected will be included in the value and chargeable to GST accordingly. So 0.25 crores, 25 lakhs will be taken. So what is the total value of supply of Dhumaketu? So 10.1 plus 0.65 plus 0.25, that is 11 crores. Now here if you see the question, compute the value of supply of Big Bang and Dhumaketu. So what is the, and also assuming that both of them wish to adopt minimum value of supply, to the extent possible. So Big Bang will be 9.09 crores and Dhumaketu will be 11 crores. That is the correct answer, option A. Then which of the following activity is liable to GST? Liable to GST, so that we need to select liable to GST. Supply of food by hospital to inpatients not admitted or their attendants or visitors. So patients, inpatients is only exempted, but outpatients, not admitted means what? Outpatients. So that will be taxable. We don't have any exemption with respect to that, it will be taxable. Then transportation of passengers by non-AC railways. So railways only AC or first class is taxable, non-AC is exempted. Then services by a brand ambassador by folk dance performance. See, services by performance artist in folk dance, like a folk or classical art form of music, dance and theatre is exempted, but they should not be acting as a brand ambassador. So only if they are acting as other than brand ambassador, it is exempted, but they are acting as a brand ambassador here, that's why it will be taxable. Suppose if they are not acting as brand ambassador, and it is exempted if the value of supply does not exceed 1,50,000. Transportation of agricultural produce by air. So in case of airways, agricultural produce is not notified. So which means it will be taxable. So notified goods, agricultural produce is notified goods and it is exempted. Transportation is exempted if it is transported by railways or if it is transported by waterways between places in India, or if it is transported by goods transport agency. Airways we don't have the exemption, so therefore it will be taxable. Services by way of loading, unloading, packing, storage and warehouse of rice, that is exempted. So now which are taxable? 1, 3 and 4. So option C is the answer, 1, 3 and 4. Then question number 8, which of the following statement is correct in relation to value of imported goods determined under rule 4 of customs valuation rules, that is transaction value of identical goods. So what is the meaning of identical goods? Identical goods are also imported goods having the same physical features and quality and imported at or about the same time of importation, and it should be substantially the same quantity and in the same commercial level. But if you see here, the transaction value of identical goods in a sale at any commercial level, no, it should be the same commercial level and in substantially the same quantity. So any commercial level is wrong, that's why this option is wrong. The transaction value of identical goods in a sale at the same commercial level correct. And in any quantity is wrong, it should be substantially the same quantity. So option B is also wrong. Option C, the transaction value of identical goods in a sale at same commercial level and in substantially the same quantity. So both are correct. So option C is the correct answer. Option D, the transaction value of identical goods in a sale at any commercial level and any quantity, both are wrong. So therefore option D is wrong. Then safeguard duty cannot be imposed if the article on which it is proposed to be imported originates from a developing country. It's not developed country. It should be from a developing country, provided the share of imports from each developing country does not exceed 3% of the total. So that should be developing country, but here it is given as developed, that's why it is wrong. The article on which it is proposed to be imposed originates from a developing country, correct, provided its share of import is not more than 5%, wrong. So that 5% is wrong, it should be actually 3%. The article on which it is proposed to be imposed originates from more than one developing country and its aggregate share of imports from developing country each with less than 3% share taken together does not exceed 9% of the total imports of that article into India. Each country with less than 3% taken together does not exceed 9%, correct option. That is the correct answer. So we have two exemptions with respect to safeguard duty. Once a safeguard duty is fixed for a product, and if you are importing that product from a developing country and the percentage import from one developing country, that is we are importing only from one developing country and the percentage import does not exceed 3% of the total, then no need to pay. Suppose if we are importing from more than one developing country, then developing country with less than 3% taken together, that group does not exceed 9%, then on that group there is no safeguard duty. Okay, imports of such goods from that group. Okay, then the article is imposed by person in special category state. No, we don't have anything, but actually SEZ or 100% EOU we have an exemption, but that is not given here. Then question number 10, this question is actually given already in RTP, some past RTP, that is, so we have three products, product M, N and O, and product M and N are sold in India as well as exported, and is a product which is covered under RCM, like that one question. So based on that question only they have given. So this question is mainly related to 17 subsection 3, meaning of exempted supply. Have a look into this. Janaki Nandan Associates, a proprietorship firm in Lucknow, registered under GST, manufactures three taxable products, Zeta, Sigma and Omega. These are the three products. The following information has been provided by Janaki Nandan Associates for a particular tax period. So they have given the transaction details, various transaction details, and they have given even the inward supply details also. You are required to compute the net GST liability of Janaki Nandan Associates payable from electronic credit ledger and or electronic cash ledger as the case may be for the given tax period using the above mentioned information. And all the above transactions are exclusive of GST wherever applicable. Assume that GST rate on inward and outward supply of goods and services are 12% and 18%. So for goods we need to take 12%, services we need to take 18%. Subject to the information given above, assume that all other conditions necessary for availing ITC have been fulfilled. And turnover of Janaki Nandan Associates was 72 lakhs in the preceding financial year. Unless otherwise mentioned, exports are made under LUT. So in case of exports, there are two options now, upon payment of IGST, without payment of IGST. So therefore, they are telling if it is mentioned as upon payment of IGST, it is upon payment of IGST, otherwise it is without payment of IGST under bond or LUT. That is this. So now, in this case, first transaction if you see, Omega and Zeta sold in domestic market as well as exported outside India. So what we need to do, we need to prepare a working note. That working note contains particulars, value for payment of GST, for availment of ITC, what it is. So like that we need to prepare one working note. So the working note, we need to take working note, particulars, then what is the value for payment of GST, and for availment of ITC, okay. So first, if you see what is a transaction, omega and zeta are sold in the domestic market as well as exported outside India. The domestic turnover of zeta and omega are 21 lakhs and 15 lakhs respectively, excluding export sales. And sale of zeta, sale of omega, 21, 15. Sale of zeta and sale of omega, 21 lakhs and 15 lakhs, and actually these are goods. So goods will be taxable at what rate? At 12%. So 21 lakhs into 12%, 2,52,000, and 15 lakhs into 12%, 1,80,000. For availment of ITC, it will be treated as taxable only. So we don't have any restrictions. Then next one, we need to take export turnover of zeta with payment of IGST. So export upon payment of IGST, and they are not eligible to avail any benefit under merchant exports, is 3.75 lakhs, and omega worth rupees 15 lakh is exported, and they have said export of zeta is with payment of IGST, but omega they did not say, means what? Assumption, they have given the question itself. So without payment of GST. So with payment of IGST is 3.75 lakhs. So that is export of zeta, export of omega. Export of zeta, and export of omega. So 3,75,000, which is upon payment of IGST. So into 12%, that is 45,000, and for the purpose of ITC, it will be treated as taxable only. Zero rated supplies are treated as taxable whether you pay IGST or you don't pay IGST. And export of omega, if you see, that value is 15 lakhs, but that 15 lakhs is without payment of GST, no GST, but even then it will be treated as taxable for the purpose of availment of ITC. Then next transactions, if you see, tax on sigma is payable under RCM. So whatever is the outward supply that is covered under RCM, it will not be taxable in the hands of the supplier, and outward supply covered under RCM is treated as exempted for the purpose of ITC. So sigma value is what? 9 lakhs. So sale of sigma 9 lakhs, sale of sigma 9 lakhs, and it will not be taxable in the hands of supplier, it will be taxable under RCM. So for supplier, for ITC purpose, it will be treated as exempted. Then next one, the firm is also engaged in providing taxable consultancy services. They provided consultant service of 30 lakhs has been provided to unrelated clients located in foreign countries. In all the cases, consideration has been received in convertible foreign exchange. In order to qualify as export of service, 5 conditions should be satisfied. Supplier should be located in India, recipient should be located outside India, and then place of supply should be outside India. Consideration should be in convertible foreign exchange. Supplier and recipient are not establishments of the same person. Here all the conditions are satisfied, so therefore it will be export of services 30 lakhs. Export of services 30 lakhs, and in the absence of information it is exported without payment of GST under bond or LUT, so no GST. However, export of services, even though without payment of GST, it will be treated as taxable for the purpose of availment of ITC. Then next one, the firm sold shares held by it for 375 lakhs, which were earlier purchased at a price of 360 lakhs. Sale of shares is not at all a supply, but what should be taken as a value here for the purpose of ITC? It should be treated as exempted, and the value will be 1% of sale value. What is 1% of sale value? 375 lakhs into 1%, 3,75,000. So sale of shares, actually sale of shares is not a supply, but for ITC purpose it is treated as exempted. And what will be taken as a value? 3,75,000, 1% of sale value will be taken. Then this is given in 17 subsection 3. Due to shortage of funds, it sold one of its factory building for 180 lakhs, excluding stamp duty of 3.5 lakhs, being 2% of the value. The entire consideration is received after receipt of completion certificate. Building was occupied thereafter, so which means that it is excluded from supply, not a supply. But as per 17 subsection 3, it should be treated as exempted supply. What should be taken as a value? Stamp duty value. What is the stamp duty value? 3.5 lakhs is the stamp duty, which is 2% of value. So if 2% is 3,50,000, then what will be the total? So 3,50,000 divided by 0.02. So 1,75 lakhs will be taken as the sale of building. So sale of building will be taken as 1,75 lakhs, and it is not a supply, but for the purpose of ITC it will be treated as exempted supply. Then next one, the firm earned interest of 6 lakhs on money invested in fixed deposits. Interest on loans, advances, deposits is actually exempted, but for the purpose of ITC it will be treated as taxable. So 6 lakhs interest income, interest on FD 6 lakhs. So that 6 lakhs is actually exempted for payment of GST, but for determining ITC it will be treated as taxable. And these are the outward supplies. Based on these outward supplies, we need 3 informations. That is, what will be taken as the for availment of ITC, for availment of ITC, what is the meaning of taxable turnover? What is the meaning of taxable turnover? This is only for ITC computation, okay? Taxable turnover, exempted turnover, and total turnover. That is the sum of taxable turnover, exempted turnover will be the total turnover. So what is the taxable turnover? If you see, so 21 lakhs, wherever it is taxable for the purpose of ITC that you take, 21 lakhs plus 15 lakhs taxable, then 3,75,000, then 15 lakhs, then 30 lakhs, then 6 lakhs. So this 90,75,000 will be taken as taxable turnover, 90,75,000. And what will be taken as the exempted turnover? So same way you see exempted 9 lakhs exempted, then 3,75,000 is exempted for ITC purpose, then 1,75 lakhs so is also exempted. So 1,87,75,000, 1,87,75,000. So total plus 90,75,000, that will be 2,78,50,000 will be taken. 2,78,50,000 will be taken as the total turnover. Now we need to compute the ITC. For the purpose of ITC, we have the inward supply data. The details of inputs and input services availed by the firm during the said tax period are as under. The firm received legal services from an advocate in relation to product Zeta for a consideration of 5.25 lakhs. Legal services for Zeta. Zeta is fully taxable. So Zeta we don't have any exemption etc. because Zeta either sold or exported. So it will be taxable. So full ITC available. But first of all, is it taxable or exempted? We need to see. Legal services provided by individual advocate or firm of advocate to a business entity whose turnover during the previous year does not exceed threshold limit is exempted. If you see here, the turnover during the previous year is 72 lakhs, exceed threshold limit, therefore it will be taxable under RCM. And on this we can take full ITC, there is no restriction. How much is that? 5,25,000. And so we are computing the ITC. Computation of ITC, that's the second area. Second working note is related to computation of ITC. So first we will see ITC availed. ITC availed. Thereafter we need to do ITC reversed. So then net ITC available for set off. ITC availed legal services. With respect to legal services, what is the value of legal services? 5,25,000. Services means 18% is the rate of GST. So 94,500. 5,25,000 into 18%, that will be 94,500 will be taken as ITC on legal services. Then next, remaining inputs and input services availed during the tax period worth 52.5 lakhs and 22.5 lakhs respectively have been commonly used for supply of goods and services mentioned above. So inputs 52.5 lakhs, common inputs is 52,50,000. GST rate is 12%, so that will be 52,50,000 into 12%, 6,30,000. Then common input services. So what is that common input services? If you see common input services, 22,50,000. So 22,50,000 into 18%. So 22,50,000 into 18% is 4,05,000. So this is the ITC availed. 4,05,000 plus 6,30,000 plus 94,500, 11,29,500. Now minus ITC reversed. So what is the ITC reverse? 11,29,500 into. So how much is the exempted turnover? Already we computed. 1,87,75,000. 1,87,75,000 divided by total. What is the total? 278,50. 2,78,50,000. So now you will know what is the ITC to be reversed. 11,29,500. But we are making a mistake here. So we don't have to reverse full ITC. Why we don't have to reverse full ITC? Because legal service is exclusively used for taxable. Only the 6,30,000 and 4,05,000 is common. So 6,30,000 and 4,05,000, which will be 10,35,000. So the 10,35,000 only we need to reverse. 10,35,000 into 18775 divided by 27850. So that will be 6,97,742 is the ITC to be reversed. So the balance is known as the net ITC for set off. So what is a net ITC for set off? 11,29,500 minus this 4,31,757 is the net ITC for set off. So 4,31,758 we will round off. So that will be the net ITC for set off. Then what's the next thing? We will compute the net GST payable. So for computation of net GST payable, computation of net GST payable. So what is it we need to do? First we need to take gross liability under FCM. Gross GST under FCM. So what is the gross GST under FCM? FCM liability already we computed here in the table. So for payment of GST, 2,52,000, 1,80,000 and 45,000 is the GST payable. 2,52,000 plus 1,80,000 plus 45,000, that will be 4,77,000. 4,77,000 is the net GST under FCM minus ITC. What is the ITC? Already we did 4,31,758. 4,31,758. Once we reduce, we will get net under FCM 4,31,758. So 45,242. Add RCM liability. RCM liability with respect to what? Legal services. Legal services provided to business entity will be taxable under RCM na. So what is it? Legal services 94,500. So now if you do the total of this, 94,500 plus this 1,39,742 is the net GST payable. So you can have a look into the answer here. So what is it they have given? First working note related to GST liability. So total GST payable on outward supply, if you see 4,77,000, that's what we got. And thereafter we have, so common credit reversed and net liability, net GST payable 1,39,742. 1,39,742 is the net GST payable, that is the answer. So that's how we need to do the computation related to this question. It's a very good question, long time I have been awaiting this type of question to come in exam, so chances are there. Then question number 11, Jigyasa Limited has multiple wholesale outlets of toys in Mumbai, Maharashtra. It receives an order for toys worth rupees 1,20,000 inclusive of GST, leviable at 18% from Upasana, owner of retail toy store in Delhi. While checking the stock, it is found that order worth rupees 55,000 can be fulfilled from company's Bandra, Mumbai store, and remaining goods worth 65,000 can be sent from Gorgan, Mumbai store. So with respect to single order, if they are shipping the consignments, two separate consignments, means they will be preparing two separate invoices. Both the stores are instructed to issue separate invoices. Okay. So as there are separate invoices, even though the consignor and consignee is same, separate invoices, but as per CBIC FAQ, so we have to give two separate e-way bills. We have to give two separate e-way bills. Have a look into the answer for this. So Jigyasa would be required to prepare two separate e-way bills. Okay. So since each invoice value exceeds 50,000. Okay. And this is based on the FAQ, even though the consignor and consignee is same, but when there are multiple invoices, with respect to each invoice, one e-way bill has to be generated, irrespective of the fact whether same or different consignors and consignees are involved. Okay. So that is the answer for this. Then next question number 12. Vivid Private Limited is engaged in supplying various services in Bengaluru. It registered in the state of Karnataka. It has furnished the following information for the month of June. Services provided by way of fumigation in a warehouse of agricultural produce. Previously, fumigation services was exempted, but now that exemption is withdrawn. So therefore, this fumigation services will be taxable. Service of transportation of passengers by metered cabs provided through Webcastle Limited, an e-commerce operator. So actually it is taxable. Generally, transportation of passengers by metered cabs or auto rickshaws is exempted. But when it is provided through e-commerce operator, it will be taxable. And as per section 9 subsection 5, transportation of passengers by any motor vehicle, liability to pay GST is on e-commerce operator. So therefore, it will not be taxable in hands of Vivid Private Limited. Even though it is taxable, but we will not take it into their value. Why? Because on this e-commerce operator will pay GST. 4 buses, each with seating capacity of 72 passengers given on hire to state transport undertaking. Such buses run on a route and timing as decided by STU. First, we have an exemption. Hiring of motor vehicles that can carry more than 12 passengers to a state road transport undertaking is actually exempted. Here, the bus is having a capacity to carry more than 12 passengers, and here such buses run on a route and timing decided by STU is irrelevant. That is irrelevant point. Whether it is decided by them or not decided by them, that is irrelevant. I have a motor vehicle that can carry more than 12 passengers that I am giving on rent to a state road transport undertaking. I get some money, that is exempted, simple. So it will not be taxable in the hands of Vivid Private Limited. Then goods transport service received from GTA for transporting the goods to be used in respect of the buses given on hire to STU. Tax on such service is payable at 12%. So goods transport service received from GTA for transporting the goods to be used in respect of buses given on hire to STU. Generally, this is inward supply. So this is not outward supply, this is inward supply GTA service on which GTA is paying GST under FCM, 12% means FCM. Can we take ITC? No. Why we cannot take ITC? Because this inward supply is used for providing outward supply, which is hiring of buses to STU, which is exempted supply. Inward supply used for exempted supply. Even though GST is paid, we cannot take ITC with respect to this. Now, what is the net GST payable? First, gross GST payable, if you see, only 13 lakhs. On the 13 lakhs, the rate of GST is 18%. So, 13 lakhs into 18% will be 2 lakh 34. And second and third will not come. ITC also not available. So, 2 lakh 34,000 will be taken as the answer. So, 2 lakh 34 nil, 2 lakh 34 ITC not available. So, therefore, 2 lakh 34,000 will be taken as the net GST payable in this case. Then 13th question, Swasthya Nursing Home, a clinical establishment, offers the following services. Rooms provided to inpatients where the room charges per day are 6,500. So, this clinical establishment providing rooms, we have an amendment. If it is ICU charges, etc., ICU charges, and ICU, NICU, CCU, etc., then ICU charges, whatever may be the amount, it is exempted, but other room charges is exempted if per day it does not exceed 5,000. But in this case, per day it is 6,500, it exceeds 5,000, so fully it will be taxable. Plastic surgery conducted to repair cleft lip of a newborn baby. Plastic surgery, cosmetic surgery and hair transplantation are not treated as healthcare service, but if these are carried out to restore the anatomy of body parts affected due to congenital defects or developmental abnormalities, then it is healthcare service, therefore it is exempted. Air ambulance service to transport critically ill patients from distant locations to Swasthya Nursing Home. So, air ambulance service, any ambulance services will be exempted. Okay, well, let it be air ambulance or road ambulance, ambulance service is exempted. Supply of food to inpatients as per the advice of the doctor or nutritionist from its restaurant Annapurna Bhavan located in the basement of the nursing home. The food is prepared by employees and nothing is outsourced. So, food supplied to inpatients is exempted. Only to outpatients, visitors, staff, etc. will be taxable. Homeopathic medical treatment. So, we have any system of medicine recognized, healthcare service provided in any recognized system of medicine is exempted. Homeopathy is considered as a recognized system of medicine. So, therefore, it will be exempted. Then, Swasthya Nursing Home also operates a cord blood bank, okay, which provides service in relation to preservation of stem cells. So, cord blood bank which provides service in relation to preservation of stem cells. So, whether it will be taxable or exempted, preservation of stem cells. So, preservation of stem cells, previously it was exempted, now it became taxable. So, therefore, it will be taxable in this case. So, that is the answer that we need to write. First one taxable, second, third exempted, fourth also exempted, fifth also exempted, and this case, that is cord blood banks, it will be taxable. So, that is the answer with respect to this. Then next question, question number 14. Alpha is a manufacturer and supplier of a machine in India. Gamma of USA helps Alpha in selling the machine by identifying its client in USA, that is Beta, who wants to purchase this machine. So, Alpha is one person who is located in India, and they are seller, correct? Seller. Now, who is the buyer? Identifying client in USA, Beta, who wants to purchase this machine. So, buyer is Beta, who is located in USA. Now, there is an intermediary who connects these two people. So, there is an intermediary who connects these two people. Who is that intermediary? Gamma. Okay, these two people are connected through an intermediary. So, gamma. So, what is the meaning of intermediary service? Intermediary service means, so they are facilitating or arranging transaction in securities between two parties, or transaction in goods or services between two parties. There are two parties who are engaged in transaction involving goods or services or securities, and a person who facilitates or arranges the transaction is known as intermediary. So, gamma facilitates or arranges the transaction. So, gamma is an intermediary. And where is gamma located? USA. Now, is it first of all taxable or exempted? We have one exemption here. Seller of goods outside India, buyer of goods outside India, if the intermediary is located in India and if the intermediary gets commission, the commission is exempted. Like that, we have one point. Seller of goods outside India, buyer of goods outside India, but there is an intermediary in India, that intermediary earning commission will be exempted. We have one point. But here, that exemption is not available. Why the exemption is not available? Because not both seller and buyer are located outside India. So, one in India. So, exemption not available. It will be taxable. And what they are asking, determine the place of supply of the services. So, what will be taken as a place of supply? Is it section 12 or section 13? Section 13 of IGST Act. Why? If one in India and the other outside India, who is the supplier of service? Gamma. Gamma is the supplier of service. Intermediary. Who is the recipient of service? Alpha. So, therefore, section 13. What will be taken as the place of supply for intermediary service as per section 13? Location of supplier. Who is the supplier? Gamma. That is USA. Will be taken as the place of supply in this case. That's the answer for question number 14. So, as per section 13, the place of supply of intermediary service will be location of supplier. Intermediary means a person who facilitates or arranges transaction in goods or services. So, for that we have got one circular. Minimum of 3 parties should be there and 2 distinct suppliers should be there. Intermediary service provider to have the character of an agent and does not include a person who supplies on his own account. Subcontracting is not intermediary service. Subcontracting means I have to do some work which I outsource to another person, that is not intermediary service. So, therefore, in this backdrop, so the place of supply of the intermediary service is location of supplier, that is gamma, outside India, USA. That will be taken. Then next question 15. Answer the following questions elaborating the relevant provisions of section 44. Section 44 is annual return. Section 44 is annual return. Who is required to furnish annual return and what is the due date of furnishing the same? Every registered person other than CAG Tonic, CAG, CAG, that is whose accounts are subject to audit by Comptroller and Auditor General. T, TDS, TCS deductor, okay, but actually TCS deductor is required to file one annual return called as GSTR 9B, but 9B is not yet notified. So, therefore, anyway you can write TDS deductor, best, safer side. So, but here in the answer to RTP they gave TDS, TCS deductor, but actually form is not yet notified. GSTR 9B form is there, but it is not yet notified for them to file that annual return. So, due to that reason, so this answer to the RTP they have taken TCS deductor also not required to file annual return, but safer side in exam you write TDS deductor only. Okay. So, registered person whose accounts are subject to audit by CAG, TDS deductor. O for OIDR supplier located outside India, making supply to non-taxable online recipient in India. N, NRTP, non-resident taxable person. I, input service distributor, and C, that is casual taxable person. These people not required to file annual return. But if you see the answer they gave, casual taxable person, non-resident taxable person, input service distributor, TDS deductor and TCS also, but no. And even Comptroller and Auditor General point is given here. But OIDR point is not given, why sir? Because that is given in notification. So nothing wrong, you can write extra point, but it is there, okay. Then what is the time limit by which the annual return needs to be filed? By 31st December of the succeeding financial year. What is the prescribed form for furnishing annual return or statement? GSTR 9, and that is to be filed by every registered person. E-commerce operator GSTR 9B and 9A by a person opting for composition scheme, but for composition scheme they have brought another return, another annual return, that is GSTR 4, and GSTR 9C is a reconciliation statement. If you see here, GSTR 9 normal, 9A they have given, but actually 9A is abolished, and in that place we have GSTR 4 and e-commerce operator GSTR 9B, and a person whose aggregate turnover in a financial year exceeds 5 crores, they are required to file a reconciliation statement GSTR 9C, and those who are not required to file annual return are not required to file 9C also, okay. That is with respect to this. Next, who is required to furnish a self-certified reconciliation statement? That is a registered person who is not required to file annual return, is not required to furnish GSTR 9C, and other registered persons whose aggregate turnover during the financial year exceeds 5 crores is required to furnish a self-certified reconciliation statement. Then question number 6, Nitya Associates is engaged in supplying taxable services in Kerala. The Assistant Commissioner of Central Tax passed an adjudication order under section 73, which was received by Nitya Associates on 18th October. In the said order under 73, okay, in the said order, GST liability of 6 lakhs was decided along with interest 18% for number of delayed days and penalty 60,000. So what is the tax? So the tax payable will be 6 lakhs, and being 73 penalty, so therefore it is 10% of tax 60,000, and interest as applicable 18% as applicable. Nitya Associates was in complete disagreement with the said order, so it filed an appeal before the appellate authority on 31st October. What is the time limit within which appeal should be made? Within 3 months from the date of receipt of order, 18th October, 31st October, within the time. Determine the amount of pre-deposit to be made by Nitya Associates. So what is a pre-deposit to be made? Pre-deposit is whether they admitted anything, no. So it will be 10%. It's a first appeal, na? So 10% of the disputed tax and subject to maximum 25 crores, but that much is not there. So 10% of the disputed tax, that is 60,000 rupees. And in that 30,000 under CGST and 30,000 under SGST, they need to pay as pre-deposit. If it is on account of any penalty order under 129, then it is 25% of the penalty, but that is not applicable here. Whether your answer would be different if Nitya Associates appeals only against part of the demand amount, say 4 lakhs, and admits the balance amounting to 2 lakhs on proportionate penalty. If 2 lakhs of tax is admitted, then how much will be the pre-deposit? 2 lakhs of tax plus interest on 2 lakhs plus penalty proportionately 20,000 plus disputed tax 4 lakhs. 4 lakhs into 10%, 40,000. That will be taken as the answer. You can see that. So first appeal, the pre-deposit will be 100% of the admitted due and 10% of the disputed tax subject to maximum 25 crores. And in case of penalty order appeal, the pre-deposit will be 25% of the penalty. Thus, in the given case, Nitya Associates has to make a pre-deposit of 10% of 6 lakhs, that is CGST 30,000, SGST 30,000. However, if they admit a liability of 2 lakhs, CGST, SGST, then they have to pay the 2 lakhs plus 20,000 plus interest plus disputed tax 4 lakhs. 4 lakhs into 10%, 40,000 should be paid. That is the answer for that. See the next question. Robert and Sons is engaged in supply of taxable goods. It enters into a contract to supply consignment of said goods. However, since it is unable to determine the value of the goods to be supplied by it, it applies for provisional assessment. So it applies for payment of tax on such goods on a provisional basis along with required documents. On 7th January, an order allowing payment of tax on provisional basis was passed by the proper officer, indicating the value on the basis of which the assessment is allowed. and what is the value for which bond needs to be executed and security needs to be furnished, etc. Robert and Sons complies with the same and supplies the goods on 29th January. So 29th January they are making the supply. Thereafter, paying the tax on provisional basis in respect of the said consignment on 19th February. For 29th January means for January month, what is the due date? 20th of February. So on or before 20th February, they paid the provisional tax. Consequent to final assessment order passed by the proper officer on 18th March, a tax of 1,80,000 become due on the consignment and Robert and Sons pays the tax due on 9th April. So now, for payment of the differential tax, interest is payable under section 60. So what is that interest under section 60? Provisional assessment. Upon finalization of provisional assessment, interest will be payable at the rate of 18% per annum from the first date after the due date till the actual date of payment of that differential amount. Determine the interest payable if any. So in this case, if you see, first, as per section 60, we need to write the provision about that interest. And what is the due date? 20th February, because they cleared on January now. So January 20th February. So from 21st February, what is the date on which they are making payment of 1,80,000? So 1,80,000 is being paid on 9th April. So in February, it will be 8 days. And in March, 31 days. And April, 9 days. So that will be 48 days. So we need to compute interest for 48 days on 1,80,000 into 18% into 48 by 365, 4,291 rupees. Then next question, 18. Jumbo Steels imported heavy machine from USA. The cost of the machine at the factory of the exporter was $10,000. The transport charges of $500 were incurred from the factory of the exporter to the port of shipment. This is transportation charges. Okay. So X factory cost is $10,000. Transportation charges from factory of exporter to the port of shipment is $500. At the load airport, handling charges of $50 were paid for loading the machine in the ship. So we need to compute the assessable value. Freight charges from exporting country to India were $1,000. Jumbo Steels paid a buying commission of $50. First, we need to take X factory cost. X factory cost plus freight up to port plus loading will be equals to FOB. To this FOB, if we add some adjustments, okay, to this FOB if we make adjustments, then freight and insurance, then what we get will be CIF. Okay. Now, what is the X factory cost? X factory cost is $10,000. Transportation from factory to the port is $500, so $10,500. And loading charges will be 50. So, FOB price if you see 10,550. So FOB 10,000 plus 500 plus 50, 10,550. We got FOB. Then what are the other informations given in the question? Buying commission will not come. Only selling commission will be included. Then freight charges from exporting country to India were $1,000. It is given. So directly take $1,000. Suppose if it is air freight, then only we need to compare actual or 20% FOB, whichever is lower. But here directly $1,000 will take. Insurance not given, so FOB into 1.125%. So freight is given, insurance 1.125% of FOB, that is 10,550 into 1.125%, that will be 118.69. So we will get CIF value, and on that CIF value we need to multiply Indian rupees. If it is given $1 equals to 70, so multiply with Indian rupees, you will be getting the assessable value in Indian rupees. That's it. It's a simple question. Then question number 19, Balu Limited imported superior kerosene oil and stored it in a warehouse. An ex-bond bill of entry for home consumption was filed and duty was paid as per the rate prevalent on the date of presentation of such bill of entry, and order for clearance for home consumption was passed. On account of highly combustible nature of SKO, the importer made application to permit the storage of such kerosene oil in the same warehouse until actual clearance for sale or usage. The application was allowed. However, the rate of duty increased when the goods were actually removed from the warehouse. So there is one Supreme Court case, Bioco Lari Supreme Court case is there, which says that Bioco Lari Limited Supreme Court case, which says that if the warehousing, that is out of customs charge order is passed, that is bill of entry, ex-bond bill of entry is filed and customs duty is paid and out of customs charge order is passed, but still the goods are kept in the warehouse, so are not treated as warehoused goods because we filed the bill of entry and we paid the customs duty, out of customs charge order is passed. So now if there is any change in the rate, we don't have to pay the customs duty. That is the Supreme Court case. Supreme Court has held that where duty on the warehouse goods is paid and out of customs charge order is passed by the officer, the goods allowed to be retained for storage in the warehouse are not treated as warehoused goods and importer would not be required to pay anything more. As per section 49, if the goods are deposited in the warehouse even after the permissible warehousing period, the goods are not treated as warehouse goods. That is this point. Okay. Next, last question that we have, question number 20. ABC Limited imported a offset printing machine from Germany for 5 crores and the bill of entry for home consumption was cleared in April on payment of duty. However, due to certain technical glitches, the said machine could not start functioning and the said machine was sent back to the supplier for repairs in May. The manufacturer of machinery in Germany has to make necessary repairs and had sent back the machine again to ABC Limited. Accordingly, ABC Limited re-imported the machine without any remanufacturing or reprocessing in September. So when exported goods for repairs is brought back, okay, so could not start functioning and it was sent back for repairs, and when it is brought back after repairs, we have one valuation. As per section 20 read with notification 45/2017, upon re-import of the exported goods for repairs, customs duty is payable on fair value of the repairs carried out outside India plus freight and insurance both ways. Since the machine was having manufacturing defect, the repairs were carried out by the machine manufacturer without charging any amount for the repairs. However, the fair value of the repairs was 70 lakhs. Fair value of repairs including cost of material consumed in the repairs of 70 lakhs would have been 90 lakhs. So 90 lakhs will be taken as the fair value of repairs, that is both material as well as labor. Actual insurance and freight charges incurred were 75 lakhs each side from India to Germany and Germany to India. So what is the fair value of repairs? 90 lakhs plus freight and insurance both ways, 7.5, 15 lakhs. So that will be taken as, so 105 lakhs. On that 105 lakhs, we need to pay customs duty, basic customs duty 10%. So 10% of 105 lakhs, 10 lakh 50,000. And on that 10% social welfare surcharge and IGST 18%. And there are certain conditions for application of this. So what are the conditions? The imported goods, that is the exported goods, should have been re-imported within 3 years. And it can be extended for a further period of 2 years, and the exported goods and re-imported goods should be same and ownership should not change. If these conditions are satisfied, then fair value plus freight and insurance both ways only will be taken. If any one condition not satisfied, then original value of the machinery will be taken. So 105 lakhs, basic customs duty 10%, 10.5, social welfare surcharge 1.05. Then while computing IGST, we need to add value plus basic customs duty plus social welfare surcharge on that 18%. So this 32.529 is the total customs duty payable. So with this, we completed the RTP discussion of May 23. So prepare well, and I am available in the Telegram for your doubt clarification, and even one more MCQ marathon video also will be uploaded. So you can just watch it and concentrate on rocket revision. So, and this mighty 50 questions and this RTP amendments, these are the area. So 1.5 days revision plan also I will be sharing. So see that. Thank you.